Randy bought a rental property last spring. Scott put the exact same money into stocks the same week. They both think they made the smarter move, and they've both been arguing about it ever since. Here's the thing, though, they're both working with incomplete math. And when you actually run the full numbers over 20 years, the answer isn't what either of them expects. Let's set the scene so this is completely fair. Randy and Scott are both 30 years old. Same city, same job, same salary, $60,000 a year. They've both been disciplined savers, and they've both got $50,000 sitting in their bank accounts burning a hole. The only difference, what they decide to do with it. Randy goes the real estate route. He uses the $50,000 as a 20% down payment on a $250,000 single-family rental home. 3 bedrooms, decent neighborhood, solid school district. He locks in a 30-year mortgage at 7% interest. His monthly mortgage payment comes out to about $1,330. He finds a tenant pretty quickly willing to pay $1,800 a month in rent. On paper, Randy is making $470 a month doing basically nothing. Scott takes that same $50,000 and puts it into a total stock market index fund. No research required, no tenants, no keys. He sets up a $400 automatic monthly contribution and goes back to living his life. When his coworkers ask him what he's investing in, he says index funds. They nod. They change the subject. Nobody's throwing a party for Scott. Day one, Randy has a house, a tenant, and a great story. Scott has a brokerage account and a confirmation email. It's not even close in terms of excitement. But excitement and math are two completely different things. For the first couple of years, Randy is loving life. Rent hits on the first of every month like clockwork. He drives past the property on his way to work and thinks, I own that. He's writing off mortgage interest and depreciation on his taxes. He's building equity every single month. Home values in the area are creeping up. Everything about this investment feels real, tangible, and smart. Scott. He logs into his account once a quarter, sees the number go up a little, then down a little, then up again. Year one, his $50,000 grows to about $55,000. Year two, maybe $61,000. There's no key in his pocket, no asset he can point to, just a number on a screen that quietly climbs. Randy's friends ask him about the property. They want to know how it's going. Scott's friends don't really ask about anything. The social validation alone makes Randy feel like he's ahead by a mile. Now let's look at the actual numbers through year 3. Randy has collected roughly $64,800 in rent. His mortgage payments total about $47,900. That's $16,900 in gross cash flow. Sounds really good, until you subtract everything else. Property taxes, about $3,000 a year. Insurance, another $1,500. He had to replace a water heater, $1,100. There was a small roof repair, $2,400. And he had 1 month of vacancy between tenants, which cost him $1,800 in lost rent, plus $500 to clean up and relist the property. Randy manages the place himself to save money, but that means weekend showings, late-night texts from the tenant, and dealing with repair calls on his lunch break. When you actually add all of that up, Randy's real net cash flow over 3 years is somewhere between $2,500 and $4,500. Not the $16,900 that looks so great on the back of a napkin. And that number doesn't count a single hour of his time. Meanwhile, Scott has contributed $50,000 upfront plus about $14,400 in monthly contributions over 3 years. At roughly 10% average annual return, his portfolio is sitting at approximately $78,000 to $82,000. $0 hours managing it. 0 phone calls. 0 emergencies. But here's where you have to give Randy his credit. He has leverage working for him. His $250,000 property has appreciated about 3 to 4% per year, and is now worth somewhere around $270,000, to $280,000. His equity, the gap between what it's worth and what he owes, has grown to about $55,000 to $65,000. That's real wealth built partly with borrowed money. The bank did some of the heavy lifting. That's something Scott simply can't replicate in the stock market. The rent check is the number everyone leads with. It's on every YouTube thumbnail, every real estate podcast, every backyard barbecue conversation. What doesn't come up is everything that drains that rent check before it ever reaches your bank account. Vacancy. The average rental property sits empty about 1 month per year. That's not a catastrophe, but it's a full mortgage payment with zero income coming in. And every time a tenant moves out, you're paying for cleaning, repairs, listing fees, and your own time screening new applicants. Maintenance and repairs. A standard rule of thumb is to budget 1 to 2% of the property's value per year for upkeep. On a $250,000 house, that's $2,500 to $5,000 annually. Some years it's a $150 drain fix. Other years it's a $7,500 HVAC replacement in the middle of July that your tenant has zero patience for. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These costs are guaranteed, it's just a matter of when. If you're not setting aside money every month for them, you're not running an investment. You're running on luck. Property management. If Randy hires a property manager, that's 8 to 10% of monthly rent, roughly $150 to $180 per month, gone immediately. If he manages it himself, he's working a part-time job without pay. Either way, it costs something real. And then there's the risk nobody likes to bring up, a bad tenant. Someone who stops paying and knows exactly how long the eviction process takes can cost you 3 to 6 months of lost rent plus attorney fees. One bad tenant can erase an entire year of profit. None of this shows up in the $470 monthly cash flow number, but it shows up eventually. It always does. By year 5, Randy is deep in the reality of being a landlord. He's on his 3rd tenant. He replaced the roof for $9,000, dealt with a plumbing emergency that cost $1,600, and had another vacant month between leases. He's raised rent to $2,000, which helps, but property taxes and insurance went up too. His cash-on-cash return, the actual money he pockets relative to what he put in, is running around 3 to 5% after real expenses. That's not bad, but it's not the 20% return he casually mentioned at his friend's cookout. Scott is still doing absolutely nothing. His portfolio has grown from $50,000 to somewhere between $140,000 and $155,000 by year 7, including his monthly contributions. He didn't time the market, he didn't pick winners, he just didn't touch it. The compounding is starting to accelerate. The gains on his gains are now creating more new wealth each year than his original contributions ever did. That curve is just getting started. By year 10, Randy's property is worth roughly $335,000 to $360,000. His remaining mortgage balance is about $168,000. That puts his equity at approximately $167,000 to $192,000. Factor in every real cost over 10 years, mortgage interest, taxes, insurance, repairs, vacancies, capital expenditures, and Randy has spent an additional $25,000 to $40,000 out of pocket beyond the original down payment. Scott's portfolio, with consistent $400 monthly contributions and 10% average annual returns, is sitting at approximately $175,000 to $195,000. He put in $50,000 upfront plus $48,000 in contributions. $98,000 total invested. Everything beyond that is pure compounding. He spent 0 weekends dealing with any of it. At year 10, they're surprisingly close in total wealth. Randy might be slightly ahead thanks to leverage, But here's the full picture. Randy also took on $200,000 in debt, concentrated everything into one asset in one zip code, and spent hundreds of hours managing his property. Scott is diversified across thousands of companies and has never lost a single night of sleep over it. This is where the story fully separates. By year 20, Randy's property is worth somewhere between $450,000 and $510,000. His mortgage is either paid off or nearly there. His total equity is somewhere between $400,000 and $500,000. And after 20 years of maintenance, repairs, tenant turnover, taxes, insurance, and at least one major renovation, his total net cash flow profit might be $50,000 to $90,000 above what he spent. More in a hot market, less in a flat one. Scott's portfolio at 10% average annual return with $400 monthly contributions has grown to approximately $450,000 to $490,000. His total contributions over 20 years were about $146,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. calls about a burst pipe. When you compare net worth at year 20, they're in the same ballpark, both somewhere between $400,000 and $500,000. But how they got there is night and day. Randy worked for his. Scott waited for his. And here's the number that quietly changes everything. If Scott had bumped his monthly contribution by just $200, bringing it to $600 a month, his 20-year portfolio jumps to roughly $580,000 to $620,000. In the stock market, adding to your contribution has a multiplied effect through compounding. In real estate, increasing your investment typically means buying another property, taking on another mortgage, and doubling your workload. Now, if I only showed you the rough side of real estate, I'd be doing exactly what stock market influencers do. So let's be honest, volatility is brutal. In 2008, the market dropped 37%. In March 2020, it fell 34% in about a month. If Scott had $150,000 in his account and watched it drop to $95,000 in a few weeks, that's not just a number on a screen. That's gut-wrenching. And the data shows that most retail investors panic and sell during crashes, then buy back in after the recovery. They lock in losses at the worst possible moment. There's no monthly cash flow. Index funds don't mail you a check you can spend. Dividends on a total market fund run about 1.5 to 2%. On a $150,000 portfolio, that's maybe $200 a month, not replacing anyone's income. And there's no leverage. Scott used $50,000 to control $50,000 in assets. Randy used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when property values rise, and it's one of the main reasons real estate has created more millionaires than the stock market in many surveys. And real estate has tax advantages stocks simply don't have. Depreciation lets property owners deduct the theoretical decline in their building's value from taxable income, even when the property is actually appreciating. That's a legal shelter Scott can't access. Real estate isn't a bad investment. It's a misunderstood one. Randy and Scott both walked away from that original decision thinking they made the smart play. Randy thought real estate was the proven road to wealth. Scott thought the market would do the work for him. Neither of them sat down and mapped out what it actually costs in dollars, in time, in stress, and in risk over 10 or 20 years. The trap isn't real estate, and it isn't stocks. The trap is choosing either one based on a YouTube thumbnail, a podcast clip, or something your brother-in-law swore by at Thanksgiving, without ever running the full numbers for your actual situation. Because the only answer that matters is the one that includes everything. So next time someone tells you real estate always wins, or the stock market always wins, ask them one question. Did you count everything? If you want to see what happens when you do both, own property and invest in the market at the same time? Drop a comment below and I'll run those numbers in the next video. Because that combination might completely change how you think about building wealth. And if this broke something down for you that nobody else did, subscribe. Because that's exactly what this channel is for. See you in the next one.